Imagine a time when one factory paycheck could comfortably support a modest family home. Many grandparents bought their first house before turning 25 without massive savings. They rarely needed huge down payments or prestigious degrees to qualify for ownership. Back then, a typical home cost roughly 3 times a worker's yearly income. Today, that same type of house often costs near 10 times average annual earnings. So why has home ownership started feeling out of reach for many people today? The answer involves deeper economic shifts that changed how money and housing interact. This story is about more than prices, interest rates, or simple monthly budgeting habits. It explains how the global financial system quietly transformed decades earlier behind the scenes. You might believe saving harder each month will eventually solve the affordability problem. In reality, the financial goalposts often move faster than most incomes can follow. Let us begin by examining how different housing looked during the mid-20th century. Back then, a house was mainly a place to live and raise children. Most families did not treat their primary residence as a high-growth investment vehicle. Housing demand stayed steady because population growth was slower across many regions. Many households survived comfortably on one income while another parent managed home responsibilities. This meant builders priced homes so a single paycheck could realistically cover costs. Major changes began after the world shifted away from the gold-backed system. In 1971, global economies moved toward currency supported mainly by government trust. This shift allowed banks to expand lending far beyond earlier historical limits. When more money enters the system, asset prices usually rise across major markets. Homes represent the largest asset most families will ever attempt to purchase. More cash competing for limited houses naturally pushes prices higher over time. Property then became a popular way to protect savings during periods of rising inflation. Investors noticed real estate often preserved value better than idle cash accounts. A basic human need slowly turned into a competitive arena of serious financial strategy. Another overlooked factor was the rapid rise of the dual-income household structure. As more women entered careers, total household earnings increased across many urban regions. Instead of lowering costs, the market adjusted upward to match higher combined incomes. When buyers can spend more, sellers and developers typically raise asking prices accordingly. Soon, two incomes became necessary just to maintain what one paycheck once covered. Your grandparents rarely competed against couples bringing two full salaries to each bid. The lending industry also changed how easily buyers could access large mortgage loans. Earlier banks demanded bigger down payments and carefully screened most potential borrowers. Later, new financial products made it easier for many applicants to secure credit. When borrowing becomes simple, buyers often focus on monthly payments instead of total price. That shift allowed home values to climb beyond levels many budgets could safely support. Zoning rules and permits now limit where smaller, cheaper homes can be built. Restricted supply combined with growing demand keeps upward pressure on property prices. Large investment firms also purchase thousands of houses and convert them into rental units. These organizations can outbid first-time buyers using deep pools of global capital. Material costs like steel, cement, and lumber have also increased over recent decades. At the same time, skilled construction labor has become harder and more expensive to hire. Modern houses are also larger, packed with features once considered luxury upgrades. Bigger designs push entry-level prices higher than earlier generations ever faced. Years of low interest rates encourage buyers to borrow larger amounts than before. Cheaper loans allowed higher bids, which quietly inflated overall market valuations. Meanwhile, many jobs concentrate inside a few expensive cities with limited available land. Student debt delays saving, making early down payments difficult during prime earning years. Rising property taxes and fees increase the true monthly cost of ownership. All these forces together created a complex storm affecting affordability across many regions. Understanding this helps people see the challenge is structural, not a personal failure. Old financial rules no longer work the same inside today's fast-moving economy. Building income, investing early, and staying flexible often matters more than saving alone. Home ownership is still possible, but it now requires smarter planning and broader strategies. Financial literacy about debt, inflation, and rates provides a real advantage over time. The era of the easy one-salary house has faded, yet opportunity still exists. With clear thinking and adaptable choices, people can still build stable and prosperous lives.